Meantime, another authority on the bond markets is Dan Fuss, who's the vice chairman at Loomis Sayles, and he says he's never seen a snap around like this in the corporate bond space. And this morning, we welcome Dan on the program. He joins us from our Tokyo bureau. Dan, so good to have you with us. First off, let's talk about these low-rated bonds returning 65% or there's about. Let me just ask, are the gains over? Because it looks like Bill Gross, the manager of PIMCO, he looks pretty pessimistic these days.
Well, it depends on which view you take of it. In general, I agree with what Bill is saying, but I don't go to the degree that he does. I do think very strongly that we will soon see, soon being next year sometime, the start of a long, gradual rise in interest rates in the U.S. and in other parts of the world. We're coming off a very low base. As far as the returns over the last year on below investment grade bonds, it's a case of same bonds, new prices. We're contrasting with a period when the bonds were sharply depressed. So do I see that sort of rally coming? No, absolutely not. Can you make some money in the area? Yes.
Okay. Well, let me just ask you, Dan, since we're on the topic of interest rates, I mean, how high do you think interest rates might get by the end of 2011 if you actually see rates starting to move then?
Probably not going up a lot by the end of 2011. I would anticipate that sometime next year short-term rates start up, and the Treasury 10-year, to use that as a guide, rates might be in the low fours. It's more the few years after that once the corporate sector is starting to really borrow money again and the Treasury continues to borrow more, that's when we get this. Remember, this is all guesswork. That's when we get the real push behind rates. This is not the end of the world in managing bonds, but it's certainly something you have to plan ahead. Clients will ask me, they'll say, well, those are words. Give me numbers. I obviously don't know the future, nor does anybody else, but I'm using for planning purposes a Treasury yield, 10-year Treasury yield by the end of this cycle right now, up around 6.25, which is a lot higher than today.
Yeah, definitely. Okay, well, Dan, I want you to take a listen to what PIMCO's global head, Mark Kissel, also had to say about the bond market.
All right.
I wouldn't say there's a bubble in corporate bonds. We've certainly had a very good ride over the last 12 to 15 months, but there still is good value in corporate bonds today in select areas such as banking, emerging market corporates, as well as taxable munis. So you can still get basically 5 to 6% returns, which still look very attractive relative to other fixed income alternatives.
Well, Dan, what do you think? Do you think Mark has a point here? There are some good opportunities in those sectors?
Yeah, there are. It depends on your time frame. I agree with his thought on that, which ought to bother him, I guess. But at any rate, yeah, you can earn your coupon now in corporates for the next few years if your selection is very careful, because the difference in yields between corporates and treasuries is still quite wide. I don't think you can earn your coupon in treasuries going out over 2 years, but I do think you can in corporates.
Yeah, what about that disappointing Treasury auction last week? Let me ask you about that, Dan, because it seems like no one wants to buy U.S. Treasuries anymore. I mean, what do you think the Fed has to do here? Do you think they might have to lift that coupon rate if possible?
Well, at some point, you know, the Fed will start to let short rates go up. The thing with the Treasury auctions is people are very well aware that there will be more of them in the future than there are now, and that is the pattern going forward. This is not unique in our market history. Oftentimes people say this is a first-time sort of thing. It's not. It's replaying the pattern of the 60s and 70s. Markets can cope with this. Our particular problem in the U.S., now I happen to be in Japan right now, and that's a different view of this. We are very anxious for people outside of the U.S. to buy our treasuries because we sell a lot of them net outside of the country at an increasing rate. And as we issue more, it is logical to expect they will ask for more income.
Okay, what
Go ahead.
Dan?
Yep.
I'm running out of time here. So let me just quickly pick up on corporate bonds because, of course, that's the attractive play, the sexy play these days, because we've seen this huge rally in corporate bond yields and value in the last few months. In fact, here in the Asia Pac, I mean, these high yielders, okay, yes, it comes with high risk, but they've rallied maybe 30% just in the last few months alone. So, you know, give me some names here in the Asia Pac you might be interested in buying into.
It's more the type. I can't give names, obviously, but it's the type. What snapped around, I've been quoted on my snap around comment, what is snapped around are the credit pictures because of the easy refinance in the market. A lot of the credit profiles, and by the way, a buildup of cash through the slowdown, the credit profiles look a whole lot better. So that covers a lot of different issuers. So it's more a factor of credit direction, coupon, price relative to par, where you go look. And there are hundreds of issues in that area.
Okay, Dan, nice talking to you this morning. Dan Fuss of Loomis Sayles. He's the vice chairman, also a very well-known name in the bond market.